I just ran the numbers on something that's been keeping me up at night, and what I found is going to completely change how you think about retirement and passive income. So here's the question everyone's asking. How much money do you actually need to live off dividends? Not some vague answer like a lot or as much as possible. I'm talking exact numbers, real strategies, the kind of math that actually works in the real world. And I'm going to tell you right now, the answer is probably way less than you think. But also way more complicated than just picking a number and calling it done. Let's start with the dream, right? You wake up, check your phone, and there's money in your account, not because you worked for it, not because you sold anything, but because companies you own shares and decided to pay you just for being a shareholder. That's dividend income, and it's one of the most powerful wealth-building tools that exists. But here's where most people get it completely wrong. They hear about dividends and immediately start chasing the highest yields they can find. They see a stock paying 7%, maybe even 10%, and think they've hit the jackpot. I did this, I lost money, and I learned a brutal lesson about how dividends actually work. High yields are usually a trap, I'm serious. When a company is paying an unusually high dividend, it's often because something's wrong. Maybe the stock price crashed and the yield looks high mathematically. Maybe they're paying out more than they can afford. Maybe the market knows something you don't. Either way, chasing yield alone is like chasing fool's gold. It looks shiny until it disappears. What you actually want is something different. You want total return. That's dividend yield plus dividend growth plus share price appreciation, all three working together. Because a stock paying 2% that grows its dividend 15% every year will crush a stock paying 7% that never grows. The math is just undeniable. So let's talk real numbers. And I'm going to use the median American income as our target because that's what most people need to maintain their lifestyle. About $60,000 a year, $5,000 a month, that's our goal. Now if you just went out and bought an S&P 500 index fund, which is what most people do, here's what you'd need. The S&P yields around 1.3% on average. So to get $60,000 a year, you'd need to invest about $4.7 million. Yeah, nearly $5 million. That's not realistic for most people. And even if you had 30 years to let it grow, you'd still need to start with like $750,000 just to hit that goal. This is why the standard retirement advice feels so impossible. Because it kind of is. If you're relying on low-yield index funds to produce income, you need a massive pile of money to make it work, and most people will never accumulate that much. But here's where it gets interesting. What if instead of just buying the S&P 500, you built a portfolio specifically designed for dividend income, not chasing high yields, but targeting funds that have respectable yields, strong dividend growth, and steady appreciation? Suddenly the math changes completely. I'm going to walk you through exactly how this works. Using real funds, real numbers, and a strategy that actual human beings can execute without needing to be finance experts. First, let's talk about the funds. I'm focusing on Fidelity Index funds because they're accessible, low cost, and you don't need millions to get started. But the principles work with any broker. The first fund is Fidelity Mid Cap Index Fund, ticker FSMDX. This one pays a 2.27% dividend, but here's the key. That dividend has been growing at 23% annually over the past decade, 23%. That means your income doubles roughly every 3 years. The share price also grows at about 6.5% annually, so you're getting income, income growth, and capital appreciation. That's the trifecta. Next is Fidelity Zero Extended Market Index Fund, FZIPX, lower yield at 1.2%. But 19% dividend growth, and it gives you exposure to smaller companies and international markets. Diversification matters because you don't want all your eggs in one basket. Then there's Fidelity Zero Large Cap Index Fund, FNILX, 1% yield, 17% dividend growth, and over 12% average price appreciation. This is your stable, reliable core holding, big companies that aren't going anywhere. Fourth is Fidelity Zero Total Market Index Fund, FZROX, similar to the others but with slightly different exposure, 1.1% yield, 19% dividend growth, 11.6% appreciation. This adds broad market exposure without overlapping too much. And finally, Fidelity U.S. Sustainability Index Fund, FITLX, for those who care about ESG investing, 1.2% yield, 18% dividend growth, 10.7% appreciation. Plus you're investing in companies that meet certain environmental and social standards. Not everyone cares about that, but it's an option. Now when you combine these 5 funds in roughly equal weights, here's what you get. average dividend yield of 1.36%. 10-year dividend growth rate of 19.6%, an annual share price appreciation of 9.2%. That's a powerful combination, not the highest yield, but the growth makes up for it exponentially over time. So let's run the numbers. How much do you actually need to generate $60,000 a year in dividends from this portfolio? If you're just looking at the current yield of 1.36%, you'd need about $4.4 million. Still a massive number, but here's where dividend growth changes everything. Because in year 1, you're getting 1.36%, but in year 2, with 19% dividend growth, you're getting 1.62%, year 3, 1.93%, and it keeps climbing. This means you don't need $4.4 million upfront. You need a smaller amount that grows into producing $60,000 over time, and the timeline matters here a lot. Let's start small, really small. Say you only have $1,000 to invest, that's it, and you add just $1 a day, $30 a month. $360 a year seems insignificant, right? But watch what happens. Year 1, your portfolio grows to about $1,466. Not exciting. Year 10, you've contributed $4,600 total, but your portfolio is worth over $9,000. It's starting to double your money. Year 20, you've put in $8,200. Your portfolio is worth $45,000. Now we're seeing real acceleration. And here's the magic moment. After 30 years of investing just $1,000 initially and $30 a month consistently, your portfolio is worth over $440,000. And it's generating almost $80,000 a year in dividends. That's more than your $60,000 goal, and you only contributed about $12,000 total over 30 years. The rest, that's compound growth, dividends reinvesting, share price appreciation, the portfolio building itself while you go about your life. That's the power of starting early and being consistent, even with tiny amounts. But I know what you're thinking. 30 years is a long time. What if you want to hit this goal faster? Fair question. Let's speed it up. Instead of starting with $1,000 and adding $30 a month, what if you started with $20,000 and added $20 a day? That's about $600 a month. For someone making decent money, that's doable with some discipline. Here's how that plays out. Year 1, your portfolio grows to almost $30,000. Year 10, you're at $185,000. Year 20, you've got $915,000. You're almost a millionaire, and your portfolio is generating about $69,000 in annual dividends. That's your $5,000 plus per month goal. Hit in 20 years instead of 30. Cut a full decade off the timeline by starting with more and contributing more consistently. And even if you decided to stop reinvesting dividends at that point and just live off them, you'd still have a portfolio worth over $748,000. That's wealth, that's security, that's freedom. Now let me address something important. This isn't a get-rich-quick scheme. It's a get-rich-slow plan, and slow is the only reliable way to build real wealth. Anyone promising you fast money is either lying or selling something, usually both. The beauty of dividend investing is that it's predictable, not guaranteed. Nothing in investing is guaranteed, but predictable based on decades of market history. Companies pay dividends because they generate real cash flow, and they grow dividends because their businesses grow. It's simple, boring, and it works. But there are mistakes you need to avoid, big ones, the kind that can derail your entire plan. Mistake number 1, chasing yield. I already mentioned this, but it's worth repeating. A stock paying 10% might seem amazing until the company cuts the dividend or goes bankrupt. Focus on total return, not just yield. You want dividends that grow, not dividends that disappear. Mistake number 2, not diversifying. If you put all your money in one sector or one company, you're taking unnecessary risk. Spread it across different industries, different company sizes, different markets. That's what index funds do automatically. Use them. Mistake number 3, selling when the market drops. This is probably the biggest killer of long-term wealth. Markets go down. They always have. They always will. If you panic and sell during a crash, you lock in losses and miss the recovery. The people who get rich from dividends are the ones who keep buying through the downturns. That's when you get the best deals. Mistake number 4, not reinvesting dividends early on. When you're building wealth, every dollar needs to work for you. Reinvesting dividends means you're buying more shares, which produce more dividends, which buy more shares. That's the compounding engine. Once you hit your target portfolio size, then you can start living off the dividends, but not before. And mistake number 5, trying to time the market. You can't, I can't. Nobody can consistently. The best time to invest was yesterday. The second best time is today. Stop waiting for the perfect moment. It doesn't exist. Okay, so we've covered the strategy, the funds, the numbers, and the mistakes. Now let's talk about the reality of actually doing this. Because knowing what to do and actually doing it are very different things. The psychological part of investing is harder than the math, way harder. You're going to see your portfolio drop 20% in a bad year, maybe 30. And your brain is going to scream at you to sell, to cut losses, to protect what's left. That's a natural human reaction, but it's the wrong reaction. The investors who succeed are the ones who can ignore the noise, who can watch their portfolio swing wildly and just keep contributing on schedule, who understand that short-term volatility is the price you pay for long-term returns. If you can't handle watching your account balance drop temporarily, you probably shouldn't be investing in stocks at all. But here's the thing. Having a plan makes this easier. When you know you're investing for dividends over 20 or 30 years, a bad year doesn't matter, because you're not trying to time the market. You're not trying to sell at the peak. You're building an income machine, and machines take time to build. One strategy that helps is thinking in decades, not days. Ask yourself, where do I want to be in 10 years? In 20, how much passive income do I want flowing in? When you focus on the long-term vision, the daily market movements become background noise, annoying but irrelevant. Another key is automating everything. Set up automatic transfers from your paycheck to your brokerage account. Set up automatic investments into your chosen funds. Make it so you don't have to think about it. The less willpower required, the more likely you are to stick with it. Willpower is finite. Systems are forever, and track your progress, not obsessively, but maybe once a quarter, sit down and look at how much your portfolio has grown, how much dividend income you're generating, how much closer you are to your goal. That positive feedback keeps you motivated. It reminds you why you're doing this in the first place. Now let's address a question I get all the time. What about taxes? Because dividend income is taxable, and taxes can eat into your returns if you're not careful. Here's the good news. Qualified dividends, which most dividend stocks and funds pay, are taxed at lower rates than regular income. If you're in the 15% tax bracket or lower, you might pay zero tax on qualified dividends. Even if you're in a higher bracket, the rate tops out at 20%. That's way better than ordinary income tax rates. If you're investing in a retirement account like an IRA or 401k, dividends grow tax-deferred. You don't pay taxes until you withdraw the money. And with an IRA, if you follow the rules, you never pay taxes on the growth or dividends, ever. That's a huge advantage for long-term dividend investors. But even in a taxable brokerage account, dividend investing is still one of the most tax-efficient strategies out there. Just be smart about it. Hold your investments for at least a year to qualify for long-term capital gains treatment. Don't trade constantly, and keep good records. All right, I want to hit you with one more thing before we wrap up. And this might be the most important point of the entire video. Living off dividends isn't just about the money. It's about freedom. It's about having choices. It's about not being dependent on a job you hate or a boss who doesn't appreciate you. It's about designing your life instead of reacting to it. When you have $60,000 a year coming in from dividends, you can take a lower-paying job doing something you actually enjoy. You can take time off to travel or spend with family. You can pursue passions that don't make money. You can say no to things that don't serve you. That's what financial independence really means. Not that you never work, but that work becomes optional. And here's the beautiful part. Once you build this system, it runs itself. You're not actively trading. You're not stressing over market moves. You're just collecting checks, reinvesting when you want to grow, spending when you need income. The hard part is building it. But once it's built, it's passive. So how much money do you actually need to live off dividends? The honest answer is it depends on your lifestyle, your timeline, your discipline, your starting point. But with the strategy I've laid out, you could hit $60,000 a year in dividend income with a portfolio between $600,000 and $1 million. And you could build that portfolio starting with just a few thousand if you give yourself enough time. The question isn't really how much you need. It's whether you're willing to start, to be consistent, to ignore the noise, to play the long game. Because the people who succeed at this aren't smarter than you. They're not luckier. They just started and didn't quit. So where are you on this journey? Are you just starting out, already building your dividend portfolio, or still on the fence trying to figure out if it's worth it? Drop a comment and let me know, because I'm genuinely curious where everyone's at with this. And if you found this helpful, make sure you're subscribed, because we're going deep on investing strategies, wealth building, and financial freedom on this channel. Real stuff, no fluff, just what actually works. Thanks for watching. Now go build that dividend machine.